Hello, everyone. My name is Brian Overby. I'm the new team member at OptionsPlay. My title is Senior Options Strategist, and I've known Tony for many, many years. I guess my one claim to fame would be that I am the author of the Options Playbook, which we're going to use today. We're going to go to OptionsPlaybook.com, and we're going to probably start there. But more importantly, this is really part 2 of our butterfly presentation. And I do plan on having a part 3, by the way. But the title of our presentation is Your Butterfly No Longer Flying? And ultimately, when we get done with this presentation, that is going to be true, because we're going to adjust a butterfly and we're going to take away one of the butterfly's wings, which I know is a little sad to do to a nice, pretty butterfly, but that's what our adjustment is going to be on this butterfly. So we're going to focus on one of the butterflies I introduced in the previous, actually my first webinar ever for OptionsPlay, which is just about butterflies, and the butterfly breakdown is what the title. I lost it there for a second. Apologize. I got it back though. And if you'd like to review that when we're all done, you should have, if you've attended the first session, you should have received an email with the link to it. But if not, you can just email info@optionsplay.com and they will send you that link, no problem. And also a copy of the slides. So with that said, welcome to Options Play Education. We're trying to, here's one little thing that I've been teaching options for 30 plus years. And I don't know, today I don't have the camera on today, but you've probably seen my ugly mug if you've been a part of the Options Play platform, and I've been actually doing a lot of the daily plays, and we're adding videos to those daily plays. So a little bit of a video introduction on it. And those daily plays, not only that, if you're not actually looking for a trade, they're very educational. Talk a little bit about the concepts that are involved with the strategy, why we're picking the expiration that we're picking, why we're picking the strikes that we're picking. They're usually in a couple to 2 to 3 minutes. We try to cover that to go along with, obviously, we like this stock, we're bearish or we're bullish because of this or that. So I strongly suggest that you check out the daily plays, which I've been working on for the last couple of weeks, actually, adding videos to most of them. All right, so disclaimer, it is important that anything that we talk about is not meant to be a recommendation, and past performance is not indicative of future results. I know that's not the word, but I came up with it fairly quick. All right, so today we're just going to look at one butterfly. So we know what a butterfly is. If you're here and you don't know what a butterfly is, this is going to be a very over-the-top presentation on it, because we're going to start with a butterfly and then we're going to modify it, and then we're going to adjust it. So we go butterfly, modified butterfly, look at the adjustment for when it's gone against us, and we'll just talk about when we want to do that adjustment. And I got that titled as best practices, and then we'll have a Q&A. So this is really important in that I'm going to ignore the chat box. If you have questions, please do put them in the Q&A box. So I will not answer them if they're in the chat box. You can chat amongst yourselves, but if you got a true question, and if you put it in there, I'll see it. I might not address it right at the moment, but I'll be happy to address it at the end. All right, now, when we go through this entire trade and the adjustment, the entire presentation should take about 40 minutes, but I like to talk, so I get a little bit long-winded. And there will be a recording, and we will email the recording with the slides later on. All righty, so here's for the free trial. If you are not an Options Play client and you would like a free trial, it goes for an entire month. Please just scan this right now or go to optionsplay.com/sign up and you will have access to the daily play and all the education, and you'll get a plethora of emails that are more about education than anything else, but every once in a while asking you to, if you want to join the free trial. Okay. So here was the butterfly team that we put together from last week. We went in and looked at a standard butterfly, just flat out butterfly, kind of boring. If I do a standard butterfly, I'm usually doing it right at the money, maybe using 0 DTE options in an index like the S&P 500. Or look at a modified butterfly. This is what we're going to focus on today. We're going to modify the butterfly, so we're going to pay a little bit more up front. You'll notice, like, even this is actually graphically makes sense in that on a standard butterfly, you pay a normal amount. You can lose that if it's down below, or you can lose it, if it's down below or if it's up above. This is a put butterfly that we talked about. Stock was trading up here, and this is where our middle strike was. Now, if you modify it, you pay a little bit more. But if the market goes up, you can lose that. So you're losing more than you are over here. But if the market goes down, you can actually make money. So this is open-ended if it goes below this put strike on our modified butterfly. And then we also introduced a skip strike butterfly, which I really like. I think of it as a good alternative to actually a credit spread. Now, on this instance, we're showing that it's done for a net debit, but if I'm doing a skip strike butterfly, I'm going to do this for a net credit. So the marketplace, if the market goes up on the skip strike butterfly with puts, you would have a small net credit. And on the way down, you got a lot of risk on the downside. So basically the exact opposite of the modified butterfly. But a lot of people will call this a modified butterfly. I prefer skip strike because you're literally skipping a strike and betting a call spread in it. Or a put spread in this instance, to pay for the butterfly. All right. So I already have a question. What kind of adjustments would you do if a butterfly was put on in very low volatile environments and it keeps being challenged on the upside? I don't think it's going to change. That question was asked by N, and we answered this live, so I'm just going to let that one go away, because that's what this is about. You can look at the adjustment, and the adjustment will apply. We're going to do the put side of things, because this is where we started with our butterfly team, is on the put side of things. But the adjustment could be applied to calls, so I'd say hang on. Jessica is no longer with Options Play. She's moved on, and I'm with Options Play now at this point in time. But that's not tied together. Let's put it that way. All right. When is a put butterfly most efficient? Oh, Chris, we haven't even got into the butterfly yet. You guys are kind of getting there. Efficient is a strong word. I could say butterflies are cheap when implied volatility is high, right? And if you put on a butterfly and the market goes towards your short strike, you would want implied volatility to come in. And I'll leave it there. Oh, wow, we're getting way ahead of ourselves. Let's get into the adjustment, and then we're getting a lot of questions just about butterflies in general. I'll try to address as many of them at the end of the show. So I'll keep the last two that just popped up, I'll keep those for the end of the show. Okay, so I am going to minimize this. And we're going to start by looking at my book, the Options Playbook. And let me zoom in a little bit on this. And we're just going to talk about a standard butterfly. And I'm going to show you the basis that's behind my adjustment, the thought, the theory that's behind it. Okay? So if you just look at a standard butterfly, it's a ratio. You're buying the stock that, if we're doing put butterflies, which this one is considered a long butterfly with puts, if you're doing these, the stock is, if I'm doing puts, I'm being directional. It usually means that I want the market to go down. So the stock is up here somewhere by strike C. You want it to drift lower down to strike B, hang out there, and then be there at the expiration date. So we're going to buy a put at strike C, then sell 2 puts at strike B and buy a put at strike A. Very low risk, right? It's the net debit that you paid for it, but you need it to stay within the wings of the butterfly. Now, how is this trade made up? If you look at this, if you buy a put at strike B and just sell one put, I'm sorry, at strike C, and then sell one put at strike B, what you have is a long put spread. It would go up like this, and then it would extend out. And then on the other side, if you sold that same put at strike B and then went lower on the scale and bought one at strike A, that would be a short put spread. And it would look like this, and then you would go this way. So I'm going to click on those. So basically what a butterfly is, it's a combination of a long spread and a short spread. This line gets offset by this line, and you come up with a long butterfly. Now, why am I showing you this? I can tell from the questions that almost, well, at least everybody that's asking the questions has a pretty good feel for what a butterfly is. But the reason why I'm bringing this up is because this is going to be our modification on the butterfly. We're going to roll into and out of spreads by doing this trade. We're going to start with the first modification, which means we're going to start with a butterfly, and then we're going to roll into a spread when the market goes against us. But if you look at these two spreads, right, the long put spread wants the market to go down, and the short put spread wants the market to go up. Now remember, and let me scroll this up a little bit, just so it's a little clearer. Okay, there we go. So the long put spread wants it to go down, and a short put spread wants it to go up. When we started this trade, we were hoping that the market would go down. All right, what happens if it goes up? Well, we start losing money on our put, but what strategy out of these two strategies is bullish? Well, the short put spread, right? I want the market to go up, and this part is the short put spread. So if we have a butterfly on and the market is going up, this is going to be the most expensive put, strike C, because it's closest to where the stock is at, even though it's running away from us. So let's sell that. But if we sell that, we are short 2 of strike B. So strike B is less than strike C, right? So let's buy one back. So basically, we're closing the long put spread that is still worth something because the market is running away from us, and this is worth less because the market is running away from us, and this is a bull trade. So you close this out, and you end up with that. And that's the adjustment. Thank you for coming. No, just kidding. All right, so let's go through an actual trade. And Tony and I had a long conversation with this because this is a strategy that I like to do in the SPX. And in particular, the big reason why I wanted to bring up and start with butterflies, because considering, let's think about this. This is my first presentation to Options Play. I jump right in with a butterfly. But September and October, I like to do butterflies in the VIX index. I like to do butterflies in the SPX. And in particular, in September and October, I'm usually bearish with the trades that I'm doing. So the platform right at this moment doesn't support the SPX, but to me, the SPX is a cash settled index. It has daily expirations, 0 DTE options, and it's big. So you can go wide with your butterflies, and there's some premium in it because it's big. And so to me, I really like the SPX. The NDX is too much. The SPY is, a tenth of the value. So a 20-point wide butterfly in the SPY is only 2 points wide. I'm sorry, a 20 point wide butterfly in the SPX would only be 2 points wide in the SPY. And that changes the pricing dynamics. That's a very, very tight butterfly. Even though you could do 10 of them, right? Because it's a tenth of the value, it's still, the pricing dynamics are different. And that, I'll leave that for a different day. So this is my favorite underlying to do the SPX in, and that's what we're going to roll with. Okay, so I put this whole example together today. Let's hope I got all the math right. But I did this today, so we're using live quotes. Well, the VIX trade that I put on at the end of September is doing pretty well. The VIX is now at 2055. And like I said, if you're doing butterflies, and yeah, I'm looking at the Q&A. I apologize, I got distracted. Okay, and if I look at the modified put butterfly, the SPX, when I did this, was probably this afternoon when I grabbed the quotes. The SPX was at 56.8963. Markets were moving. I tried to screenshot the quotes, but expiration is 5 days away. Now, this is a Wednesday expiration. I'd rather do this during the week. I don't necessarily want the weekend into this trade because we all know that Mondays in October, well, I don't know if we all know that, but in general, if there's been a big downturn in the marketplace, it's usually a Monday in October after a long weekend. So I prefer to do, I don't mind doing 5 days. So you do it on a Monday, take it off on a Friday. But I did it as of today. So I went 5 days out, which is a Wednesday, and we're looking at the October, well, today is October 3rd. So we're looking at the October 9th expiration. All right, shoot, I wrote that 3rd. So this is the 9th. Today's date is the 3rd. So it's 5 days away. So you got to keep that in mind. So here we go. Buy one SPX, October 9th expiration, 56.85 put. That was trading at these prices, and the prices matter. So I didn't just say this is the net debit. But if we put this trade on, this is a modified put butterfly. This is the profit and loss graph that we're talking about. How did we modify it? Well, the long put spread that we talked about is 56.85 down to 56.60. That's 25 points. Now, on the short put spread, that goes 56.60 down to 56.40. That's 20 points wide. Now, what does that do? The short put spread brings in the credit. So by not going further down to the 56.35, by not going 25 points, we don't bring in as much of a credit. So we have to pay a little bit more for the butterfly. And I looked at it. I wasn't going to take a screenshot of it or anything. But if I went down to the 35, this was trading for about 230, 235. Like I said, the markets were moving. So it was about 70 cents cheaper. So why wouldn't I do that? Well, I can make 70 cents, or I can pay 70 cents extra. And if the market goes all the way down here, the difference between the width of this and the width of this is what the value of the butterfly would be if the market tanked and it went boom all the way down. Okay, so that value is 5 points because this is 20 points wide and this is 25 points wide. The difference is 5 points. But we had to pay more for it, and we still had a net debit in the account of $3.05. So you take 5 minus $3.05, and you're up $2.95. If you're dead wrong, well, you wouldn't be dead wrong because the market came down. But if the market surprised you, blew through your short strike, and continued on down, you could still make $1.95 on this trade, which is a very good profit on a $3.05 net debit, which is our total risk of the trade. So on this side of the coin, if we're looking at a real life profit and loss graph, we would see this would be $305 for every 1x2x1 butterfly, or 3.05. In this instance, 1.95 here. Maximum upside would be 25 minus that net debit, or 21.95, and that would be right here. All right. Now this is a midpoint fill, and in the SPX, the markets are really moving, but in the SPX, you're looking for a midpoint fill. The markets are artificially wide. I used to work at the Chicago Board Option Exchange where they trade the SPX, and you get really good markets. There's a lot of people that make markets in the S&P 500 index. So I would want to trade somewhere towards a midpoint. Now, so here's our max risk, like I mentioned. Our break even, now here's what's interesting compared to a standard butterfly. Where do we break even at? Well, there's instead of 2 break evens, you only got 1, right? Because down here we're profitable. So that is this strike minus that net debit of 305, I guess I would point right here. And it's 56.81.95. So if we hold it all the way to expiration, which very rarely do with a butterfly, but if that did happen, this is where our break-even point would be at. Okay. So, everybody know what to do if the market goes down in this instance, right? That's simple. If the market goes down to 56.60 and the market was at 56.89, well, I want to get out of this trade. And I do want to emphasize this before I move on to the next point is, if I'm putting this on for $3, I'm not thinking I'm going to make $22 on this trade. And if you do, which I've always used this phrase, you should get the stupid award for doing that, because you should have been out of the trade a lot sooner. If you rode all the way to expiration and you got lucky enough that the stock or that the SPX or the index stopped at 56.60, well, you should have been out a lot sooner than that, right? Because you shouldn't have taken on that risk. So if I'm doing a trade that's got 25 points is the width of the spread here, and that's the max upside minus the debit, of course. If I can double on this trade, I'm definitely going to get out. And in this instance, if it's a $3 trade and it happened tomorrow and I was up $1, well, yeah, I'd probably get out of the trade. If I'm closer to the expiration, 5 days away, and I make it to Monday, well, maybe I'm gonna shoot for a double on this trade. But a double is very good when you're doing butterflies. You pay 3, you sell it for 6. That's a good trade. Have realistic expectations when you're doing these trades. Okay, and I always do it 1x2x1 to try to make the math simple. You can apply how many contracts you would want to do. And I'll leave the last little tidbit at this. If you did a 10 lot and the market came down right away to 660 and you were up a couple of dollars on the trade, well, I don't mind you closing out 8 of them and letting 2 of them ride. Okay, that's a different scenario, and I've done that before with my own trading. But I definitely want to realize that it's very hard to obviously have the stock stop right at that strike. Okay, so with that said, P&L at 56.60. At 56.60, the profit and loss is, only because we're here, is going to be 21.95. At 56.60, if we're at expiration, it's going to be 25 points minus the net debit paid, or 21.95. All right. How do you determine the strike structure? Well, just quite simple. If I'm looking at these strikes, and this is 25 points, the smaller the width on my short spread, like how we started out, the short spread, if I make this 56.45, I'm going to have to pay more of a debit. So I do something that's feasible. It's going to cost me about, let's call it 70 cents to go from the standard butterfly to the modified butterfly. And to me, that's worth it, because I'm going to pay an extra 70 cents up front. But if the market blows through my short strike, I got the potential to make $1.95 on the back end. And it just makes me more comfortable being in the trade overall. All right. So, blink of an eye. And these are real prices but they're based off of today's numbers. So they're going to change a little bit in the real world because you're very rarely going to put on a trade and then adjust it the very next second. But grabbed a little drink there. But I basically did this based off of a 1% move in the SPX. So today is Thursday. We wake up tomorrow and we see the SPX up 1%, which is a real good, that's a big move in the SPX on a one-day basis. It happens. 2% is usually the most that it will move. Every once in a while we'll go over 2% on a one-day movement, but a 1% move is a big move in the SPX from all my years of trading it. Okay, so we're dead wrong on our forecast. The market went up 1%, which is really 57 points, but we'll call it 60. And it's now at 57.49.63. So I adjusted my trade. I went down and looked, even though we have the same strikes here, I went down and I just adjusted it and got real pricing based off of this. So if I did this trade, and the market went up 60 points as of today using real market prices, the net debit would be $2, meaning that we'd be down 105 on the trade, or about 34%. I may not adjust it at this point in time, but that's a pretty big percentage loss. If you got a fairly large position on a 10 lot or a 5 lot, that's going to hurt, right? So at that point in time, do you want to adjust and realize the market has now gone up and you got momentum to the upside? All right. So max profit is still the same. The break even is still the same. We're down $2. We could sell it and get out, and that's not a bad alternative either. We just sell the trade, lose our $1.05 and be out of the trade. But here's the adjustment. Here's what we do. Now remember everything that I just talked about on the playbook, okay? We're going to ignore this option for right now, but realize that it's still in your account, right? And exactly what I said based off of the playbook. You got a short put spread and you have a long put spread. We're going to sell the long put spread. And if you notice with my slides, I got really tricky and I highlighted everything that's basically different from this slide over here. Okay, so we're going to ignore this, but realize that it's still there. We're going to sell to close the most expensive option contract, the one that's closest to the money, and then we're going to buy to close one of the 660 strike puts. Now, flip the script, right? We're now going to end up being short a put spread by doing this trade. And if we do this, we bring in a net credit of $550 to the account. So now our $550 net credit minus the $305 debit means overall in our whole gaggle of securities on this position, we now have a $2.45 net credit that came into the account as opposed to a $3.05 net debit. Now, on a 1-by-2-by-1 basis, this would be $245 that we brought in relative to a $305 debit. That sounds great, doesn't it? Market's up. We're now rolling into a short put spread, but max risk. All right. So what has happened with the max risk? Well, by doing this trade, we've now rolled into a short put spread. And I'll run to the next slide and show you that, okay? So now, in this instance, this option is gone. We are now short just one. Now remember, this is the 8th. This is the Wednesday, 5 days away. So I'm really sad that I didn't change that. I grabbed this one instead of that, but this is the 8th. And this put, and these were real prices, right? So this is $21.90 when we start. I'm going to highlight that too, okay? So these were the prices when we started. It ended at $305. Market ran up. Then these would be realistic prices. This would be midpoint. The market ran up. And now we're here selling the most expensive one, buying that one, 245 net credit. But the biggest thing is that our max risk changes. This option's gone, it's closed, we sold the close, we bought the close, we left ourselves with one, and we are long one here. So we went from this profit and loss graph now to this profit and loss graph. We are now short a put spread. Max profit totally changed, $2.45 now. Our max profit was a lot on the other trade, but we were only trying to make a double, so we were trying to make about $3. We said if we got a double, we'd want to get out. Now we see it's $2.45. So our max profit is $2.45. Our max risk has completely changed. So if you do this trade, this is very important because you are now short one 20-point put spread. You have to have the margin to be short a 20-point put spread. So I like this trade in a little bit because it doesn't let you over leverage your account if you're planning on doing the adjustment. But realize the market has now gone up. And when we started going all the way back to here, we wanted it at 56.85. Well, we got rid of that and the market went up 60. So now you're 85 points away from that short strike. And I'll say that once again, slower, right? Because we're selling to close this. We were hoping it would come down to 56.85. We were wrong, or at least the market was wrong. It didn't agree with us, right? But we were probably right. The market just went the wrong way. But with that said, if the market comes down to 56.85, right, we were happy. Well, now we got rid of that. And so it's up 60 plus this difference, which would be 85 points total. So now we're, what, 1.5% away? Maybe maybe a little bit more, 60, 120. Well, yeah, about 1.5% away from our short strike. And the market's going in that direction. And this is our credit spread. We're short the 56.60, short the 56.40. Net credit is 245, and we want the market to stay above our short strike. This would be 245, and this would be where our risk would kick in. And the market is now way up here on the profit and loss graph. All right, so now our break even, it becomes this put minus this net credit, or $5 and $5,675.55. That's our break even. But once again, I'm not going to really ride it all the way to the expiration date. And you know, I use this a lot, but when you're doing a trade like this and you bring in this type of net credit, you got to realize you did lose some money on your long put spread, right? So if you can make, like, even if you can buy this back for $1 in this instance, you're still making $1.45 on the trade, on the whole trade, not just this trade. You're making $1.45 on the whole trade, and you might want to just do that to get out if you're nervous about this risk. Most of the time when I'm doing credit spreads, the for sure out for me is if I can make 90% of 80 or 90%, sometimes depends on the underlying. But if I can ever buy this back for a dime or a quarter or 20 cents, I would buy that back in a heartbeat on this trade. Okay, so now what do we do if the market comes down? And you say, now this thing's trading for $5 to close it. We got $2.45, market totally whiplash, came back, and it's now trading for $5 or $6. Get out, right? I'm not going to adjust it again. It's a 5-day trade. There's no more adjustments to make. We set ourselves up, in the SPX, which, there's not as big a gap opening. You can do this in Apple, you can do this in a stock, but the biggest thing that you worry about with stocks are gap openings because you can't adjust. You can't get out fast enough. But in the SPX, you don't usually have if you're going to go down 2% or up 2%, it doesn't usually happen on the open instantly. It'd have to be major news for that to happen, right? So I'm much better, if I'm doing these adjustments, I like to do them in indexes. or SPY. If you want to do it in the SPY, feel free to check it out. But I prefer large indexes, and part of the reason why I don't like to do the NASDAQ as much is you're going to be much wider, and then when you roll, you're going to have a much bigger requirement on your spread just because it's a very expensive index. Okay. So don't forget, free trial, optionsplay.com/sign up, or you can put your phone up right now and you can scan that. And I think I'm ready to answer some questions. If you have any questions, I'll leave this up for a little bit for you. I see there's quite a few in here because I know I just blew your mind, ultimately, right? So let me go back to see where I'm at. Okay. So the very first question by N just says, what kind of adjustments would you do if a butterfly was put on in a very low volatile environment? Well, first of all, if it was a very low volatile environment, I wouldn't necessarily put on a butterfly because they're going to be fairly expensive in low volatile environments. The biggest thing, the reason why butterflies are interesting is when you got a very expensive underlying that you know as expiration approaches, it's got to go to zero, right? If we go all the way back to look at our initial strikes in here, right? This is a 5-day option contract. These are out of the money puts and they're trading for $30. But guess what? At expiration, these are all time value, right? And if the market doesn't move at all, they're all worth zero. So that's a situation. First of all, I don't want to put on a butterfly. I want expensive option contracts. And if I'm right on my forecast, I want them to become inexpensive at expiration. So shorter term. As a matter of fact, a very popular trade right now in SPX options is to do a 1-day butterfly. Say the SPX is right here, put it on and see if it stays within the wings, because you get so much premium in an SPX option contract. That's a very popular thing to do. Put it on at noon, hope the market stays within the range and take it off on the close, or just let it go into the close because it's cash settled in the SPX, which I absolutely love. Okay, and then there's an extra part to this. And it keeps being a challenge on the upside. The extreme bull run start from end of 20 and ended recently. Oh, so you did long-term and low vol is what I'm seeing. Yeah, that's a tough one. I don't, you could do the spread, but man, you'd have a long position on for a long time, and that would be the adjustment. The only adjustment that I really do in butterflies is what I'm showing you. That's simple. Or you just take it off. And that would be just managing your risk. If I was doing a low volatility butterfly and I was going out further in time, I would probably just use the old, I put it on for this, I'm going to sell it for that. That's the way I think I would approach it. All right, let's scroll down. When is a put butterfly most efficient? Well, I think I just covered that kind of, right? On high price underlyings, what you ideally want is something with some volatility and some predictability. And I know that's an oxymoron, but I feel that that is true about an SPX. Like I said, a 2% gap open or in the SPX is just very uncommon. So I don't want to do a put butterfly or a call butterfly around earnings because I don't have any predictability. I might do a modified, but I don't want to do a standard butterfly per se. So I ideally want exactly that. Some volatility with some predictability. A more expensive underlying is easier to do butterflies in just because of the pricing dynamics. Thank you, Chris. What are the scenarios where a call butterfly is more advantageous? Well, it's just direction. If you're doing an at the money, say go all the way back to this standard butterfly, I usually use calls just because it's easier to understand. But I'm going to use a call butterfly, a put butterfly if I'm directional. I want to trade the out-of-the-money option contracts that are lower in value than an in-the-money option contract, right? So if I'm targeting something where I think the market's going to go down, I'm going to use puts. If I'm targeting a price where I think the market's going to go up, I'm going to use calls. And if I'm at the money, I just use calls because they're simpler. Michael, why do the presentation and then answer the questions? So there we go. Thank you for that suggestion, Michael. Mr. Anonymous, how about we hold off on the Q&As? Okay. Is it possible turning a losing credit spread into a short butterfly? Yeah. Is it possible turning a losing credit spread into a short butterfly to reduce your losses? Another Mr. Anonymous, my question, I will do it the other way around, and that's going to be probably the next presentation. Is it possible to take a long spread instead of a short spread and turn it into a butterfly and use that to try to offset some of your losses? And the answer is yes. Now, on the credit side of things, it's a little bit tougher, but if I'm doing a long call debit spread and the market goes down, just sell the credit spread. Bring in a credit, lower your debit, and then you got a chip in the chair. If the market comes back and lands within the wings of your butterfly, you're okay. Okay, trying to get caught up here. Yeah, so there is some possibility to answer your question, Mr. Anonymous. Upper long put at market price. Yeah, no, well, they're not market. Everything that I used is midpoint pricing. Market prices would be insane in the SPX, right? Because it's a very high value index. And you can usually trade, the more legs you have in the SPX, the more likelihood that you're going to be able to fill at the midpoint. How do you determine strike price structure? Well, I think I went through that, Jonathan. I'll tell you this. In the SPX, I sometimes will go 30 points wide, but it's all about the risk if you roll the trade, right? So the wider you can do the butterflies, the quicker they pay out. Okay, so for example, let's get off of this slide and go up one, right? This is 25 points wide. And just think about options in general. If you've traded a lot of options, if the market comes down to 56.85, that's an at-the-money put. All that juice is in here. You want this option contract to decay because you got to buy these back and close them. Well, what's going to decay faster? A 56.60 put or a 56.55 put further out of the money? Right? Those out of the money option contracts decay at a very accelerated rate. They got a lot more theta than the at the money ones. Well, theta's bigger on the at the monies, but on a percentage basis, it's real big on the out of the monies. So if you make this wider and it gets to this strike, man, you're probably making money just by getting to the strike. So that's how I determine my structure. I did this here because when we roll, your credit spread is going to be 20 points wide, which that's not ridiculous to have, a 20 point wide margin requirement or $2,000 minus the net credit received. But with that said, if you go 5 points wider, well, then it's a 25 point wide when you make the adjustment. So it's all about what risk tolerance you're willing to have. Okay. Am I considering deltas? Not really. As a matter of fact, I'm watching the spread more than anything. In the SPX, I did it. We started how many points down? 56, 89, 85. So we started fairly close to where the stock is at, and I'm usually within 5 points, maybe 10 points. If I go 10 points, it'll be a little bit cheaper, right? But like I said, a 1% move in the butterfly world or the SPX world is pretty big. So from 89, so we'll call it 90 down to 60, that's 30 points. That's 0.5%. So I'm doing it for 5 days. So I'm looking more so at what's a realistic number that the SPX can move. And I think it's more often than not, the SPX moves at a 0.5 percentage point move than it does a 1% move, right? So that's what I'm looking at. I'm just looking at that underlying, and I'm dealing with it that way. Not the delta at all. You could. So Deke said this is a different adjustment. This is a totally different adjustment. So here's what Deke said. Why would you not sell the 56.85 and just buy another 640 put? So why not sell this and buy that? And Deke, can you answer that question? You would bring in a bigger credit, right? Because you're not paying for this one. Let me see if I scroll down. Do you got the answer, Deke, if you think about it? If I do that, I'm long 2 of these. My requirement is no longer 20 points. It's now 40 points. But if I did that, I'm going to bring in a lot bigger net credit. And when would I do that, Deke? I would do that if it got away from me. We looked at a 1% move, right? What if we woke up one day or we took a nap or something and the market was up 2% before we knew it? Well, that's an alternative, but you'd have to have double that margin requirement. And I've done that before. So what Deke is saying here, so let's go down one more slide. Here we are selling and buying one of these. Well, why don't we sell this one and buy this one? And then you're talking about, we'll just call it $9 as opposed to $5.50 net credit. Well, you double the risk. It's that simple. And if the market gets away from you, well, then maybe I will double the risk because we're another 60 points higher and I still need to get this $5.50 net credit. And by the way, this is, our goal was to make $3 on the trade. I'm totally doing this based off of this net credit. If I can get an alert when this hits 550, then I want to get that alert, and then I want to go in and make my adjustment. I'm not looking at delta. I'm not looking at anything. I want to get somewhere around $5, right? Because if I paid $3 for this trade to start with, what's an acceptable net credit for the risk that I'm receiving? All right, SPX is at, yeah, that is, okay, done. Can we do the same thing with SPY? You can do the same thing, Al, but the big difference in the SPY is that you're 20 points, you're 2 points wide versus 20 points wide. And this is what I'm talking about. The market comes to 56.85. This is 25 points away in this instance, right? So it'd be 2.5 in the SPX to make it equivalent divided by 10. And just the pricing dynamic is different. You would do a 10 lot, but it's just different. I don't know how else to tell it. And it doesn't settle in cash. So just letting it ride to expiration gets a little bit iffy too. But if you want to start in that, I'm okay with it. I'm okay with it. Does that make sense though, Al? I hope it does. If you don't get it, you just got to sit there and it's one of those things where you're in the shower and all of a sudden a light bulb goes off. Oh, I get it. Any views on doing it in a rut? Yeah, the rut is fine. Rut is just, some predictability is not there as much in the rut, but I don't mind doing it in the rut. The rut, I'd rather do it in the rut than in the NDX. But obviously it's risk, especially in the rut, the bounce back, the whiplash, if you're incorrect. But I don't mind the rut. What range works for that? Daily? I think we answered that. How would you adjust SPX quickly? Change 56 as short strike. How would you? Well, if it came down to 56.60, I'd probably just get out. So the question is, what if we woke up, the stock was here, instead of going up 60, it came down to 56.60 instantly? In that instance, you're not going to be up a lot. I would probably get out. But here's the beauty of this. That is 100% the case, Wesley, if I was in a standard butterfly. But if it comes to 56.60 and keeps drifting down, remember, we got this down here. I do not mind at all if it goes down to 56.40, 56.30, right? So I'm less apt to just close out right away, but I'm not going to adjust it if it goes quickly. Man, how many more we got here? Holy cow. Great questions, by the way. We still got 200 people in the room. That's beautiful. Do you consider major events? No, I don't want to do major. Well, major events are going to happen all the time. I might not do it like FOMC was going to say 50 basis points versus 25 basis points last time around. I might not do it that week, right? But all the other weeks where we knew they were going to do nothing, the FOMC doesn't scare me. Because if you're just trying to avoid news, then you're just never going to put a trade on. How do you trade with the VIX? No, I trade with the VIX. Jim, that's for a different side. I was going to do one, actually, that would have been very profitable at the end of September, but I did one at the end of August going into September, and I did one personally in my own account, modified with calls to the upside. That's too hard to get into right now, Jim. I'm almost done. I'm dying here. It's 5:07 here in Charlotte, North Carolina. Yeah, if I'm a Jai, I'm sorry if Mr. Wu or Mrs. Wu. If would it be good to close if next day sees 25% P&L? That's up to you, but you just want to be consistent, right? I want to be. Would it be good to close if I'm up 25%? I mean, in general, no, probably not. I'd probably want to see at least 50%. It's just not you'd just be closing way too much, way too often. 50% would be the lowest, but like I said, usually I'm looking for a double. If I put this trade on to start with, right? My first thing that I do is turn around and put in a sell order for $6 on this. I'm going to manage the risk if it goes against me, but limit orders are fine. Good till cancel limit to sell this at $6. I'm definitely going to do that instantly because I want $6. Mario, this adjustment works for all three of the butterflies. It does, but obviously it changes a lot of things. I like it for this one the most, but on a standard butterfly, it works fine too. Yeah, not necessarily a delta. Not really. I'm looking just at the width. If you can go wider, you go wider. It's all about the risk you're willing to take after. So this was the question. Brian, what delta would you choose for the body and the wings? And my answer, as far as the wings are concerned, is it's all about think of the adjustment before you put on the trade and how much capital it's going to take you to adjust the trade. So Alex asks about the zero DTE butterflies. If you're going to do a zero DTE at the money butterfly, when is the best time to do it in the SPX? I'm going to put in the words SPX. And around 11 a.m. Eastern time, noon Eastern time, that last half of the day, man, you get a lot of time decay in the SPX. But also be prepared because if you're wrong, it's going to go against you really fast too, right? So yeah, it's yin and yang. You're going to have extremely high deltas extremely fast if those option contracts go against you. And it's going to hurt. So if they go out of the money, well, that's just it. Zero DTE options are exciting and scary. Ron, this will be emailed to you if you signed up. You'll get a link with it. I'm not sure if Philip's in the room. Maybe he can tell us this. I'm not sure if it's going to be on YouTube. I think it's going to be an email link. All right, let me go. I'm going to fly through a couple of these. What's the win percentage of backtested? I don't have that number. Jason, I prefer to recenter for a little more more debit. Jason says, I prefer to recenter for a little more debit. That way I don't take on all the risk when closing just one side. Excellent, Jason. Do some modifications. I'm giving you the concept. The concept I really explained at the very beginning using the Options Playbook website. That's what the concept is. A butterfly is a long put spread with a put butterfly is a long put spread and a short put spread. You can start with a butterfly and go into the short put spread, or even go into the long put spread if you want. You can. This is what's neat about a butterfly. So if you want to modify it, go ahead. Nothing wrong with that. How far would you go out on an expiration date? Well, if I was doing something that was not as high in value, not a 5,700 point index, I would go out maybe 2 weeks. But butterflies only pay when the center strike gets sold. So, I want to make sure of that. But 5 days. I like to do them on Mondays and close them on Fridays. And I don't even mind if with the VIX at 20 right now, I wouldn't mind doing it on Wednesday and closing it on Friday. And why do I say that it matters that the VIX is at 20? Because then the butterfly is going to be cheap with only 2 days left, right? Because the vol premium is there. Jim had to take off. He said, thanks, Brian, and thanks to all you for hanging around. So Jim's gone. That was just being funny. All right. With that saying, Jim had to leave. I guess I have to leave too. It's 5:13. We're well over the time. Thanks for coming. My name is Brian Overby. Follow me on twitter.com. Well, I should say formerly known as twitter.com. Twitter.com. On x.com, my name, it's simply at Brian Overby. Very, very simple. At Brian Overby. My name, Brian with an I. And we can go all the way back to the beginning. Here's the free trial. Please sign up and check us out. Get all the research, all the daily plays. And there's my name, Brian Overby. Feel free to follow me on x.com, and we'll come back and we'll adjust a long call spread. That's going to be the next one. So make sure you sign up. Thanks for coming, everyone.